Welcome to Key Points for December. This month, our take on the new COVID variant Omicron and what this means for economic activity in the months ahead, how the financial markets are likely to digest this news, particularly as we approach the end of the year, and with the president renominating Fed Chair Powell for a second term, what this means for US monetary policy going forward. Now, to the first point, we always expected the COVID virus to mutate. That's what viruses do after all. However, this latest development is again a bit disturbing. It's too early to know a great deal of the details, but it comes at a bad time of the year. We had already seen economic activity being slightly impacted in Europe as further new restrictions were brought in place because of a pickup in the Delta variant. And this new variant, of course, leads to, again, greater uncertainty with the potential of more restrictions being put in place at a time of year that is critical to many shopping and retail outlets due to the festive holiday conditions and consumer spending at this time of year. So it will have an adverse effect in terms of economic activity, particularly in Europe, I think, in the coming months. But the broad economic drivers are still very much in place. And as we look into next year, we think again, globally, growth will be significantly above trend. But again, it's another hurdle that we have to get over in the short term. Now, turning to our second point, financial markets have been in very rude health, particularly equity markets this year. Many are up over 20%. And what this latest virus variant does is it creates a degree of uncertainty, particularly as many managers are closing their books towards the end of the year. And there will be a temptation to lock in some very good profits. Now, we think actually this is quite sensible. We have become more cautious ourselves and are waiting until we get more clarity on the virus and the efficacy of vaccines before we look to becoming more bullish again on risk assets, equities and credit for next year. Now, we suspect they will do well, but again, in this short-term period, particularly around year-end, markets are likely to be volatile and some caution is required. Now, as we look to the United States, we're pleased that Chair Powell has been renominated at the Fed. We think this gives a continuation of policy that we've seen. Now, we've already embarked on tapering of quantitative easing. We have seen 15 billion reduction in asset purchases in November, another 15 billion in December. But we think this needs to be brought forward somewhat. The economy is very strong in the US. We see this in the ISM service data looking really robust. We've seen a dramatic fall in unemployment. The jobs market is very hot. And right now, we don't believe there's any need to be buying additional assets in the form of treasuries and mortgage-backed securities. Consequently, we would like to see this taper accelerated, and that will free the Fed's hands up later in the year to when they need to raise interest rates. We still think this is some time off, but they've made it clear that they want to separate the asset purchase program for hiking rates. And by bringing the asset purchase program forward, it will free up their hands from a timing perspective. Now remember, you can read the full report as always on Zurich.com, and please look out for our year ahead outlook, which will be coming out in the coming days.